This is TreppWire Week in Review for week ending August 19th, 2022. I'm Martha Kocher with Trepp, a data modeling and analytics firm for the CMBS, commercial real estate and CLO markets. I'm with our experts, Lonnie Henry, head of CRE and advisory services, and Robert Jordan, head of CMBS. This week, investors picked over the Fed minutes for clues on future rate decisions, and markets were mixed after a fresh round of data. Key retailers reported mixed results. Last month, retail sales stalled as gas prices dropped. The housing market showed signs of a slowdown. Housing starts fell last month, as did building permits, and existing home sales dropped for the sixth consecutive month as median prices eased. Lonnie, a lot of news to digest this week.
Yeah, I think you've covered a lot of different topics there, Martha, so we'll kind of dig into them and hit the highlights here. So the headline here is the Federal Reserve minutes that were released on Wednesday, which were separate from last month's policy meeting. Said officials agree they needed to keep raising interest rates enough to slow down the economy, would likely need to hold rates at that level until it was clear inflation was decelerating. Same story we've heard for the last several months. So I don't think there was any earth-shattering revelations in the minutes. They didn't really reveal anything that the market didn't already know. Fed officials agreed, to continue raising the rates. I think, the takeaway here, we've talked about St. Louis Fed President James Bullard several times on the pod. He's been pretty adamant that they need to continue to raise rates and more aggressively than they have been. So he actually said that he feels a 75 basis point increase should be what they do in the September meeting. So more to come on that. Unemployment, another new story here that's kind of been in the news for the last couple of months, where the job market has been really, really stable. Labor market's super tight. New applications for unemployment benefits actually inched down this week. Just another sign of continued strength in the labor market, even though the overall economy maybe is starting to show some signs of slowing. So initial jobless claims, which is effectively a proxy for layoffs, declined slightly on a seasonally adjusted basis to 250,000 last week. Sales of new previously owned homes, you mentioned the housing market slowed down. This is a slight contradiction, and I'll point that out here in just a moment. Sales of previously owned homes fell nearly 6% in July compared with June, and that was according to a report from the National Association of Realtors. The same month, year over year, sales dropped about 20%. So there was a quote from Lawrence Yun, the chief economist for the Realtors, that said, in terms of economic impact, we're surely in a housing recession because builders are not building. He went on and talked a little bit about the impacts of interest rates and median home prices. Where I think the contradiction comes in is that during that same period, typical home went under contract in just 14 days, which matches the fastest ever recorded, time from listing to contract, which I believe was recorded last month in June, or 2 months ago in June at this point. So really, we're seeing a slowdown in terms of price appreciation. We're seeing a slowdown in terms of builders building new inventory. We're seeing some contracts fall out, but it seems like there's still an appetite on the buy side of people going in and entering into contracts. So a lot of news in this week. It's interesting to see. The macro seems to be about the same, where there's some warning signs, some clouds forming, but I don't think we heard or saw anything this week that would really change the overall sentiment compared to where we were a week ago.
Yeah, I think that's right, Lonnie. Things are pretty much status quo from a week ago. The Fed showed that they're not going to be really moved by inflation kind of coming off its highs. In the most recent print, sounds like they're going to stay the course and get to their 3.5 by the beginning of next year. That should continue to slow things from a price appreciation standpoint on the residential market, and similarly in the commercial side. So turning a little bit to the CMBS market, just as a bit of an update there, spreads have come in a bit in recent weeks after broader market volatility we've seen throughout the first half of this year had been driven by optimism from a potentially earlier Fed pivot. But at this point, it sounds like the Fed's kind of putting a little bit of cold water on that, to your point, and staying the course. So it sounds like some thawing that we've seen might only be temporary. We saw two conduit deals priced in August, the week of the 8th. The bank deal came in tight of guidance on the 888, 152 over, but that deal widened down the stack 35 bips to 610 over SOFR swaps at the BBB level. and B36 from the B mark shelf priced at the offer at the AAA, but similarly widened further down the stack. The BBBs were out about 45 basis points from Whisper to 621 over. In the CRE CLO space, Rialto and FS actually upsized an offering they had by 150 million and priced it on August 10th. Rialto retained the bottom three tranches after splitting the D tranche into two. The AAA was tighter than the most recent comp at 270 over 1 month SOFR. Looking at the pipeline, it seems like there might be a bit of a freeze back. There has been some thawing, but it might cool again because the warehouse lenders are at the bank level are seeing some pressure from their size. So it sounds like they're getting cut off from their risk groups potentially, saying that they have too much exposure. So a lot of them are full on that. So they're causing some of the issuers to have to either pony up a little bit more equity to hold the line and get a little bit lower advance rate on their lines, and also widening spreads to make it a little more costly for them. So hopefully we see the thawing trend return in the near term, but given recent Fed comments, it might be a little while until we see another thaw and issuance start kicking back up. And maybe it'll need to for this in the fourth quarter to keep up with 2021's pace, which we're basically neck and neck at now. So just some interesting tidbits in the CMBS market.
Yeah, those are interesting points, Rob. If you're a podcast listener and you want that type of intelligence, in a chart or graph form or in a table, we actually posted a link on our LinkedIn page today where you could sign up for our CRE Direct product. As part of that, you have the ability to subscribe at a couple of different levels. And we actually put out a weekly newsletter using the CRE Direct framework. And part of that newsletter gives our listeners or readers recently priced CMBS conduit deals, CMBS pricing matrix, in this instance, largest loan losses for July, and a bunch of different charts and graphs that kind of give you a sense of what's happening across the landscape. So if you have a chance, go to our LinkedIn page, you can find the link and sign up for that. You can also sign up for a free version where you get emails on a daily and weekly basis that keep you up to date on what's happening in the CRE marketplace.
And it was a big week for retail earnings, and a number of big retailers announced how they performed last quarter. And it was really mixed in terms of what we saw.
Yeah, so we've talked about a couple of these. It seems like this won't be the first time. So Target, they had come out proactively a few months ago and talked about the increased inventory they had, and they couldn't get things moved off their shelves. Their prediction came true. They missed. They said on Wednesday that their inventory levels at the end of the second quarter were $6 billion higher than in the same period in 2019. Earnings tumbled close to 90% from a year ago as they had to mark down prices to try to clear the shelves of that inventory. And then revenue was 153 million in the second quarter of 22, which was down 42% compared with the prior year on just 21.1 million customers making one or more purchases within the last 12 months. So as it pertains to those inventory levels, that's 6 billion higher. Roughly 3 billion of that had to do with higher unit cost, while 1 billion to 2 billion was related to ordering merchandise earlier to get in front of a slow supply chain. So we've talked about that over the last couple of months, how the supply chain disruptions, what we were feeling on the front end of the pandemic, which was not being able to get inventory, are unfortunately rearing their head now, where people having too much inventory. So Kohl's was another one that took a dive. So Thursday, after the retailer missed their fiscal second quarter expectations, they also slashed their full year outlook. High inflation hurt their middle income customers, starting to take action to reduce excess inventory. I think very similar to Target, you're going to see slashing of prices to try to move their retail stock. On the post earnings conference call, their CEO said that the retailers lean towards selling discretionary general merchandise, such as apparel, was being disproportionately hurt in a high inflation, slowing economy marketplace. So, Kohl's and Targets are the two negatives. On the positive side, though, Walmart was a beat. They reported its revenue rose 8.4% in the second quarter, even though there were fears of the pandemic and inflation-related shifts, in consumer behavior and buying patterns could hurt sales. And their CEO noted the company really was proactive and successfully reduced its inventory levels via markdowns, leading to smaller profit margin, even though they had sales growth. So, some interesting stories. I know, Rob, there were a few others here. I don't know if you wanted to highlight maybe Home Depot or Lowe's, but I thought those were pretty interesting as well.
Yeah, Home Depot's beat Wall Street's expectations Tuesday. It sounds like contractors and home builders are continuing to spend on home improvements. Home Depot posted 5.8% increase in same-store sales, and it raised prices across its stores to offset a drop in customer transactions. On Wednesday, Lowe's reported their second quarter earnings that beat analyst expectations. The company said it improved operations, offset lower than expected sales, and were hurt by a shortened spring. And declining sales for the second quarter in a row at Lowe's were caused amid a flagging demand from its non-professional customer base. So homeowners are cutting back on discretionary purchases, and that kind of sounds like a theme across the retail landscape right now. Either they're cutting back or moving lower in quality. So I think that theme is continuing as inflation tends to pressure the pocketbook across the consumer base.
On Home Depot, Martha, it's a little bit interesting because we talked about the real estate market showing some signs of slowing down and the builders, stopping construction. Home Depot, when compared to Lowe's, is generally considered the contractor version. And for them to have a beat and show 5.8% increase in same store sales, I found that to be pretty interesting. I don't know if you had any thoughts on that.
Yeah, I did. They both seem to have been hurt by the number of transactions, and yet Home Depot, probably because it raised its prices, performed better. I also thought it was interesting that when you compare, the story about retail sales last month was flat, but when you looked under the covers, it actually was slightly higher when you stripped out gasoline and autos. And diving further in some of these earnings, Walmart did really well. And their CEO said that part of the reason is because their strength is coming from spending by wealthier families. And that was a similar story at BJ's. BJ's talked about their business model working well in the current consumer environment. So I think consumers are spending money in different places and probably trying to apply their dollars where they can get a better value right now.
I wonder how many of those new Walmart customers used to be Target shoppers that have maybe moved to a little bit lower price option.
The other interesting thing on Home Depot beating, to your point on the contractor side of things, it seems like with the rate environment being where it is versus a year ago, I imagine a lot more people are thinking about staying put in their homes. So it sounds like improvements are happening from a contractor standpoint. Maybe you want a new kitchen or a new bath, and you're willing to do that and spend your money there as opposed to buying into all-time high, potentially, housing prices. I think that could be another catalyst driving Home Depot versus Lowe's.
So while we're on the topic of retail, let's stick with retail stories. And I'm sure a couple of our listeners have noticed that Manus is out this week. However, he is always with us in spirit. And in fact, one of the stories that he shared with us was not necessarily a critical one, but an interesting slice of life. The Mall of America's Chapel of Love announced that they're going to close at the end of the month after over 28 years of, I guess, marrying almost 8,000 couples. I don't know what would possess somebody at the mall to just decide to run to the Chapel of Love and get married. But if indeed you are that type of person, they're having a going out of business sale. If you need to get a quick ceremony in, I think you can go to the Mall of America and get hitched.
I think it's euphoria from riding the roller coaster through the amusement park in the middle of the Mall of America that inspires people to get married there.
Yeah, I was going to say, like, you could buy the dress, you could get a tux rental, you could have the food in the food court, and you could do the honeymoon on the roller coaster. It's kind of like an all-in-one. Like, I miss Manus on this because I'm sure he actually would probably have a story of knowing somebody that got married there and probably did something similar about a tweed jacket, and got married at the Mall of America Chapel. But hey, somebody's going to get a good deal for the next few weeks until they close shop.
Yeah, exactly. So let's dig into some of the stories. Let's start with the green shoot because I think it's only proper.
Yeah, so we are kicking off with the green shoot here. Brandon Brown from the Phoenix Business Journal. Scottsdale Promenade, about a 600,000 square foot power center, southeast corner of Scottsdale Road and Frank Lloyd Wright Boulevard in Phoenix, just sold for $180 million. I think that just shows this is like we said, about a 600,000 square foot power center, big box anchor retail selling for $180 million. We talked at length last week about the resiliency of the retail market coming out of the pandemic. I think this is another great sign for that sector in a market that, has been fairly hot over the last few years. One other one here. So Kate Carlson, the owners of the shops at Centerpoint Mall in Grand Rapids, have sold the property in a $63.5 million transaction. So again, we had a couple of mall stories over the last couple of weeks. This is another continuation of that. It's another mall in the Grand Rapids area having sold. There was one other story here. Kaufman and Jacobs LLC has purchased a retail center in Southfield, Michigan for $45 million. This property was anchored and junior anchored by retailers such as Best Buy, Michaels, PetSmart, Ulta, DSW, etc. Mall is 97.8% leased at the time of sale. So another good indication of strong retail market. I think this is probably the third or fourth story in the last few weeks we've talked about Michigan. So it's been interesting. Michigan has shown some resiliency. And then on the transitioning maybe to some crabgrass here, we have a big 2013 loan that's heading to special servicing, facing imminent maturity default. This was according to the August servicer data. $103.2 million Coastland Center loan has been sent to special servicing. And based on the remittance comment, the loan is facing imminent maturity default. This was something that back in January, if you were a TreppWire subscriber, we reported the loan was put on the servicer watch list. And this was due to 30 tenants having leases expiring over the next 12 months. Those tenants accounted for about 21% of the collateral's net rentable area. It's about a 470,000 square foot center in Naples, Florida. Loan makes up about 16% of the collateral behind a 2013 deal. So, some crabgrass there for a large 2013 loan.
Yeah, it looks like even with the coverage ratio being north of 120, I think that term roll is going to have any lender in this environment taking a very hard look at the assumptions on releasing that space, just because sounds like the malls overall could be struggling in the near term, and depending on how much equity wants to be put into that property, it could be a situation where you have a cascading events where you have co-tenancy clauses for major tenants potentially kicking in as they roll out. So it could be an ugly situation.
Yeah, this is one of those times we talked about where maybe it's a cash in refinance, to your point, Rob. So, the owner may have to bring a large equity contribution to get this one refinanced. Even though the debt service coverage was over 1.2, it's down from just a year ago where it was at 1.42. So there's been some decline in the NOI at this property for sure.
And the next story takes us to a mall we've talked about many times, as recently as last month, the Destiny Mall in the upstate New York area.
Yes, we won't make any more jokes about the name of the mall because this one's been so prevalent on the podcast and in the headlines that I think they've all been played out. But, back in June, we noted that there were reports that the $430 million Destiny Phase 1 loans had been extended. This is from a JP Morgan 2014 deal. Recently, more details have come through, and the impact of all the bonds up and down the credit stack is meaningful. All bonds suffered interest shortfalls this month, including the AAA. Loans were extended until June of 23. Special servicer notes indicate the borrower is going to be making monthly payments at a reduced rate with deferred interest. This is not great news for bondholders. Rob, what is your perspective on this based on where it's at and the fact that AAA investors were already impacted at this point?
Yeah, it's a pretty tough situation for anybody in that capital structure. If you're when you buy a AAA bond, you don't expect to be ever taking shortfalls. So it's a little bit surprising that it's still rated AAA. So we might start seeing downgrades to those bonds as this loan plays out. Seems like that might be a little bit behind the curve on that, but definitely going to be difficult for bondholders in this particular deal.
Yeah, there's been significant appraisal reductions. This is comprised of a couple of loans. And because the appraisal reductions have come in, the servicer is not obligated to advance interest on the full amount. So that's where the interest shortfalls come in on the bond. So definitely going to be more to come on this one. But I think it's noteworthy for us to talk about it today, given the fact that there was a little more color brought to the light from the update in June.
Before we go on to the next property sector, we had our team look at some of the underlying trends and data found in securitizations that include a ground lease. Ground leases were something that I think one of our listeners asked us to dig into a little bit and provide some color and analysis, and our team has completed that report. We'll be releasing that in the coming days. So if you're interested in looking at that, give us a shout and we'll send you a copy of it, but it will probably be posted on Trepp Talk, our blog, in the coming days. So look for that. Skipping to Office. Now, I don't know if you guys have seen the news this week. Apple says they want their corporate workers to be on site for at least 3 days a week, starting by September. So I don't know. It seems a lot of us have already been in the office 3 days a week. I'm glad Apple is now joining the party.
Yeah, it seems like they're kind of the first to plunge on that in the tech space. Everyone else has gotten a lot of pushback. It seems that way to me, at least from headlines over the last 6 to 12 months. There are very few people in the tech sector that have gone back full time just because of concern for COVID, but also just being able to do their work remotely. I think it's interesting to see that, you've seen headlines not only from Apple, but also Google came out saying that they've had issues. They potentially are overstaffed pretty bluntly, saying I remember seeing something that said there will be blood. And that
Yes, I think he said bloodletting, which it seemed a little
yeah.
extreme to me for
me too.
describing layoffs or something along those lines. I was like, ouch, that seems like a very painful, thank you for playing.
Well, the economy kind of has driven this, I think, to the betterment or benefit of these tech operators. So if you remember back a few months ago, Apple had said they needed their workers back in the office and there was threats of a mass revolt. And so Apple tapped the brakes for a while. But the overall economy's cooled off to the point now where, Google can come out and say, we think we're overstaffed, and effectively force the hand of their workers to say, if we say you need to be in the office 3 days a week, it's kind of a take it or leave it. So I think the paradigm shift there is that the employees had the leverage a few months ago, and it seems like some of these companies have taken it back, not in a positive way because the economy's down and maybe some of their businesses are going to be impacted negatively from that, but it should help the office sector from a CRE perspective, having those bodies back in the office.
I don't know if you guys saw the news this week. PwC released a survey where it interviewed about 700 executives. Half of them said that they would be either reducing headcount or rescinding offers or freezing hiring. So a pretty chilling commentary on what's to come regarding employment. On the other side, though, they're spending money on mental health benefits and other things to make the existing employee population a little bit happier about having to work either remotely or part-time in and out of the office. So it's an interesting bifurcation of what's going on regarding the office worker.
Yeah, they want them happy until they lay them off.
Until the bloodletting. Exactly.
Jeez.
All right, so we had a couple office stories. We'll start with a couple leasing updates.
Yeah, so Ace American Insurance Company, they signed a 140,000 square foot office lease renewal at the Washington, a historic building located within Philadelphia's Independence Mall. Andrew Chaming from the San Francisco Gate had a story that Netflix put an entire Bay Area campus up for sublease. This is amid turbulent year for the company. We've talked about their layoffs and staff reductions, and now they're trying to sublease a large space. So Netflix has put up, basically an entire campus in its Silicon Valley hometown. This is in Los Gatos, up for sublease, as looks to shore up unused office space. So this will be interesting to see. I mean, we've talked at length about the sublease space specifically in San Francisco area, but these campus properties are even more challenging to lease up because they're usually purpose built for a single tenant occupant, in this case Netflix. And so putting that on the sublease space availability list doesn't mean that they're going to have any takers anytime soon without some either great reductions or significant TIs for somebody else to come in and potentially repurpose that space.
Yeah, I'm not sure how you repurpose a green room. I've probably got a lot of those there. So
one other story here, Times of San Diego, Regent Properties, this is a sale, had sold 3 commercial sites, including a Carlsbad Research and Development Campus. Combined sales price for the 3 sites was just over $130 million. North County portfolio consists of Atlas, which is about a 230,000 square foot R&D campus, which also includes office space along with 2 single tenant corporate headquarters. The other 2 facilities were located nearby. They were at 5540 and 5541 Fermi Court. They make up about 115,000 square foot. That was acquired by Silicon Valley-based Menlo Equities for $42 million. So again, a couple of stories here around R&D, around campus facilities in that San Diego marketplace. And so, it's interesting, and Rob or Martha, either of you might want to comment on this. We've kind of seen the appetite for those corporate campuses go back and forth. It seems like sometimes they're really in vogue and sometimes they fall out of favor. And I think with the office market where it's at now, I'm not really sure where those things are going to play out in the marketplace. I mean, we've seen a couple of sales as indicated here in the story, but with the sublease space of Netflix, I think that's an example of where, if you own those buildings and you're not using them, there's not a great alternative use for them. And there's not really that many people that want to come in and take that type of space down from a leasing perspective.
Yeah, you end up having to cut it up a lot in a lot of cases. And as you mentioned, Lonnie, it's probably difficult to do if you have a purpose built for a single tenant. So you have to so a lot of times you can wait for the next upturn in on the corporate side before those things can get leased up again. So you could be waiting quite a long while. In addition to that, you might have to put a lot of money into it to repurpose it for the next tenant. So you can see those big hits on valuations in some cases. On the flip side of that, when you find the right tenant coming in, it could be not nearly as bad. So that's when you really have to pay those brokers to work for you. Then I was going to jump to the trading alert too. We'd mentioned there was 2 Hartford firms giving up huge swaths of space in a big 2015 loan, which was one to watch according to the Hartford Current. United Healthcare and Prudential Financial were planning to give back large chunks of space in the very near future, and CMBS investors should take note of that. The biggest concern would be the $79.3 million City Place 1 loan, which is split across 2 2015 CMBS issuances. And the collateral's 855,000 square foot office at 185 Elysium. Servicer data show United Healthcare as a top tenant with over 350,000 square feet on a lease that ends in July 23. Unnamed sources in the piece state that UHC plans to reduce its lease at City Place to about 1/10 of its current 350,000 square feet. United Healthcare represents 42% of the space in that building. So City Place 1 property is 85% occupied according to the latest servicer data. In addition to that, the lease for the second largest tenant, Bank of America, with 7.5% of the space, it also ends next summer. So there's quite a lot of roll in that space coming up as well. That $45 million piece of City Place 1 makes up 5% of a 2015 Wells Fargo deal, C31, and $34.3 million represents almost 6% of a 2015 deal, NXS4. The former deal is part of CMBX 9. And bad news keeps rolling for Hartford there. The notes that Prudential Financial is also looking to downsize by 90%. The firm is looking to offload 225,000 square feet at 1 Commercial Plaza, 280 Turnbull. That property does not back a CMBS loan, although it has in the past. The addition of this additional swath of space could weigh heavily on all the other office space in Hartford. And as we mentioned, Lonnie, getting to that point where you have a lot of that space, either sublet or just vacant space, starts putting pressure on rents across the board. We believe Pru has almost 40% of the space in 1 Commercial Plaza based on our analysis. It's another tough one for the Hartford marketplace.
Yeah, this is the challenge in the office market. So we've talked, since the pandemic that the office markets have been resilient. It's, potentially or probably because of multiple tenants being in the space and having, staggered lease expirations. But there are those instances where those lease expirations line up. And this is an example of that where, effectively call it 40+% of your building decides that they're going to vacate. And when you're only at 85% occupancy with those tenants there, I mean, that overnight drops the value of your property, ability to refinance and everything else, even cover debt service, puts you in dire straits. And so, you look at a market like Hartford, and it doesn't take too many of those buildings to have that impact where it's a systemic problem where all offices are going to be, feeling the challenges. And so at this point, to your point, Rob, that new reset rent is going to be significantly less than whatever the current contract rent is across that marketplace. And so as we talk about, impending distress, or we talk about the office market generally having some cracks, this is a really representative example of how 4 or 5 tenants deciding to downsize or move out could really change the trajectory of that local marketplace. So I wouldn't be surprised if we start seeing, some keys come back in the Hartford market based on this story.
And now pivoting to the hotel sector, we had another trading alert actually regarding a Seattle hotel.
Yeah, and this was good news. Seattle Hotel sold for above the loan balance and fees that have accrued on that property. So full payoff is possible for a 2015 CMBS loan. According to the Puget Sound Business Journal, the Arctic Club in Seattle has been sold for $31 million. The property is a 120-key full-service hotel at 700 3rd Avenue in Seattle. The sale price will come as good news for CMBS investors. The property is a collateral for a $23.5 million DoubleTree Arctic Club loan. That note is currently reported as 90-plus days delinquent, with a last payment of October 2020. In 2021, net cash flow DSCR for the property was negative, but it was also negative in 2020. In addition to the $23.5 million balance, the loan is sitting on more than $5.2 million in unpaid servicer advances, fees, TI advances, and Acer amounts. So total unpaid tab for CMBS investors is roughly $28.7 million by our calculations. The most recent value from the collateral was $26.3 million from it last summer when appraisal was done on the property. If that had been the sale price, the loan would be looking at a loss of at least a few $1 million. So the fact that the property actually came in and sold for $31 million should mean CMBS investors come out whole or pretty close. July servicer data had an appraisal reduction amount of $4.3 million on the loan. And that loan makes up not an insignificant amount of the COM 2015 LC19 deal, which is about 2%. So good news for that deal.
Yeah, this is an interesting story. I mean, we've seen a lot of these where appraisal reductions come in and then they sell at or below that or right near it. In this case, coming in and selling about $5 million above the appraisal. It didn't say in the story or in the servicer commentary what they plan to do with the property, but hopefully for the local residents there, somebody's able to reposition this and turn it around. I mean, having negative debt service coverage ratio for the last 2 years is not indicative of a viable market, but maybe it's just been mismanaged and somebody can come in and revitalize the hotel.
Yeah, maybe some thawing at the Arctic Club.
The name does sound like a 1980s name, like they maybe need to name it something cool. Like I'd probably tie into like Top Gun Maverick, everyone loves that right now. So call like the Maverick Club or something. You might get a bunch of dudes with mustaches in there, and save it.
Playing football without their shirts.
Exactly. Yeah. A couple of other hotel stories. We'll look at this Hotel Irvine in California. Sold for $135 million, which is about $250,000 per key on a 541-room hotel. Buyer was Hyatt. Actually, this is their second go around with this particular asset. They owned the property about a decade ago, and so they decided to come back and repurchase it. The hotel market, which had faced the brunt of the pandemic on the front end, has really come back strong. I know, we talk quite frequently about us traveling and us seeing it in real time. But hotel, average daily rates have been on the climb for the last year or so, to the point where if you looked at revenue on some of these hotel properties, this year compared to last year, you're seeing significant double-digit growth in terms of revenue that they're generating. And I think for these stronger markets, such as California, investors are not scared to go back into those markets and pay full premium market prices for those assets. We did have one other story here. This was via Mark Hallam. Related companies may be looking to offload its Equinox Hotel. This is a 212-room Hudson Yards asset that was fairly new construction, having only been completed in 2019. It was reported that the developers are looking to get $200 million for the hotel, which was a David Childs, Skidmore, Owings, and Merrill design building at 35 Hudson Yards. It actually has a mix of hotel, office, and retail space, including a Steven Starr restaurant known as Electric Lemon. Have you ever been to the Electric Lemon, Martha?
I have not. But, I thought it's interesting that the hotel is geared to the health conscious consumer. So, Lonnie, you probably aren't interested because they've got vitamins and supplements instead of M&Ms and Kit Kat bars.
I'm definitely an M&M and Kit Kat bar kind of guy, so I probably would have to pass on the on this hotel and the Electric Lemon.
I stick to the static strawberry.
And turning to shoutouts, JS, I turned your podcast into a verb. I was picking up my brother and he was a little late putting his son to bed. So I told him I was trepping, which is my verb to describe your podcast, Stay Liquid. And Lonnie, I know you're more particular to nouns, actually.
Well, so sometimes Martha likes to open up the closet door and show the skeletons. But for those that don't know, back in the 7th grade, I was the lead actor in a play in our local school theater department where I was Norman the Noun. And so as Norman the Noun, I, let the crowd know, the audience know that I could be any person, place, or thing that I wanted, but that I was sometimes lonely and needed a friend. And luckily, Vicky the Verb came around. So we made a pretty dynamic duo.
Wow. Okay. Well, Norman, you could be trepping. And W, he sent us an anecdotal example of the potential industrial pullback that we continue to discuss on the podcast. And in the link gave us a story about an Amazon story where their tax agreement was pulled back after their lack of new jobs never materialized. So thank you for sending us that story. Loves our podcast. NL, always giving us comments and news from overseas with some help from Guinness. Joke aside, the Irish real estate market has proven remarkably resilient over the years, enhanced by a favorable tax regime and special status post-Brexit. So she says, I suppose you'll see similar effects in the U.S. with local state tax and regulation impacting business and people's relocation. That's a question. So we'll look into that and see if we can give her some more info. Susie S. commented on last week's episode. Obviously, if you didn't listen to it, the question was, what do animal crackers and CRE have in common? And well, that was Manus's story about giving animal crackers to his kids to keep them quiet in the grocery store. And Simon H., not our Simon H., but a different one, requested recent reports referenced in our CPI and sentiment results. And Christian F. loved the episode with Rachel Brown. If you haven't listened to it, I encourage you to. She's from the Tampa Bank and had some really good color on what's going on in her market. Christian F. loved that episode and said it was great, informative commentary. And Dan M., always a pod fan, giving us commentary, content, and contacts that we're interested in. So thanks, Dan, for doing that. And, Lonnie, I know you probably saw the news because everybody knows you're a muscle car guy. Dodge is going to stop making the Charger and Challenger in 2023. So guess what? I got good news for you, though. You can get a commemorative vehicle and it would have a plaque that says last call under the hood.
Yeah, I heard the news. I was actually en route to New York this week when I saw the headline, and a tear may have shed from my eye because I definitely am a fan of the new Challengers and the new Chargers. I think Dodge did a really great job of bringing those old muscle cars back in the current environment where people thought they were still cool. And to hear they're going all electric, which means they're probably going to look completely different, makes me a little bit sad. So I'm going to be saving my pennies and trying to get on that list for one of those, commemorative editions. And if so, maybe we'll have to do a raffle or something where I could take a Trepp podcast listener on a ride in a real muscle car.
That's a great idea.
Yeah.
Sign me up. I want to do that. And with that, we'll close. Thanks to our producer, Haley Keene, and thanks, Rob, for joining us. Join us next week. Manus will be back as we look at what's happened during the week and how it may be impacting you. If you have a question, a comment, or something you want to share, send it to podcast@trepp.com and subscribe to the podcast with your favorite provider. Thank you for listening and stay well.
All right.